Whether you're a new real estate investor just taking down your first property or an experienced veteran with thousands of units under your belt, operating your multifamily deal is the make or break point for building wealth. Welcome to this property operations mini-series, part of the Bulletproof Cashflow podcast. This mini-series is hosted by my friend Jack Petrick and of course by me, Agostino Pintus, the host of Bulletproof Cashflow. In this mini-series, we'll cover what you do after you take down that deal and what it's going to take to become a successful property owner that you want to be. So let's go ahead and get into the show.
Hey guys, it's Agostino. I have my good friend Jack Petrick on as well. And if you've been following the mini-series for a little while, we're talking about property management and operations. So far we've covered so much ground. We've covered everything from hiring a property manager to lease ups to contractors to finding the right materials. We've been talking about how our roles as entrepreneurs and our fiduciary responsibility as far as lowering our expenses and increasing our income, right? So all very, very important things. And a big part of what has to happen now, especially with the last two episodes, we're talking about increasing our NOI is the refi, right? So we're taking all this effort and we're operating as best as we can to improve our NOI and drive our cap rate higher by making these improvements. And what this does is it helps the refi. That's for many syndicators, that is where the real money is made, right? So at the beginning, when you're taking down a deal, maybe you build in a fee there, maybe you don't. It depends on how you operate. But really, the refi is when you're returning a large chunk of the money back to your investors. But then, of course, as managers, as the guys that put money out of the deal too. So what you want to do is try to drive and improve the overall net operating income of that deal. So, a big part of the refi, and we talked about this before, right, Jack, is that you really want to improve NOI. And we talked a little bit about that. And maybe you can touch on maybe some of the refi experience that you've done.
Absolutely. And I've mentioned this formula in two of our other episodes here, but let me just recap it again. When I'm buying a property, I'm buying properties with financial inefficiencies. I'm looking to increase those efficiencies, so I increase the value of the building. I can then refinance the project in 2 years or less and pay my investors off. So any adjustment we make to improve the net operating income, we're going to take that dollar amount divided by the market cap rate, and that's how much we're going to increase the value of the property. So we increase the value of the property either by increasing income or lowering expenses, and it's as simple as that. If we're going to increase income, we're typically renovating so we can drive rents higher. We're bringing other income sources in. On the expenses, we're lowering expenses, renegotiating, getting more competitive. So between raising income, lowering expenses, we're increasing the net operating income of the property. And for those that might be new at this, the NOI is nothing more than income minus expenses is net operating income. Then you subtract your debt service, and whatever's left is your cash flow. That's as simple as it is. So the first thing I got to say in the refi that is most critical is having a good lender. Banks are sometimes they can be, not sometimes, they can often be slippery. Oftentimes they do a really good job of loaning money to people that don't need money. And I'm sure you've experienced, Augustino. I've experienced with dealing with direct lenders where they pull out of the deal. I've experienced it where they spend a lot of time gathering a lot of documents and information. You go weeks and sometimes a month into a deal, and they can't perform, or the deal's not good for them. It's not a good fit. So the mistakes I made at the beginning was I was looking for a lender that had low cost fees that would require me to bring less money to the deal to close with them. In fact, that was the wrong approach. If we're buying a deal, we have a significant amount of money, of earnest money, that oftentimes will convert from being refundable to non-refundable. So if you're $25,000, $50,000, $250,000 of non-refundable earnest money deal and that lender can't perform, you're done. So your name is done, the money's gone, your reputation with the broker is done, that broker's commission is now gone. So it's something we can't afford. So the one thing I just want to stress here is having an incredible lender is so integral of this process. Oftentimes when we have the appraisers come out, maybe appraisals are running short. There's objections, there's issues, and you need a team that's going to be behind you that can come with those answers and navigate through those issues. And it happens on pretty much every deal I've ever bought. There's been some issue they've had to work through. So having them on your team is so critical. I'm going to put a plug in here for Chris Litzer at Pinnacle Finance. They're a division of Marcus and Millichap out of Cleveland, Ohio. They finance $1 billion a year, north of $1 billion a year, and then commercial lending. And they have been absolutely had my back and have done an amazing job. I've also worked with Josh Cantwell with Freeland Ventures, Freeland Lending. They've been amazing to work with. They have slightly different deal appetites. And there are a lot of other lenders out there as well that are great. But taking the time, first of all, and I know I'm going into detail in this, but I'm really stressing it. Like, if you have the wrong lender, this whole thing comes apart.
Well, that's exactly it. Yeah, I mean, because not all lenders are good for every single deal. I mean, I think that's one thing that many people they miss the mark on that. You know, if you're doing a value add deal, but the lender doesn't like doing value adds, then it's done. You go to a different lender. But really, you know, and I talked about this in previous shows on the Bulletproof Cashflow podcast, is that finding the right lender. If you screw up and get the wrong bank, for instance, right, as opposed to a broker, which is different. Okay, that bank, just like you said, they can lead you down the path. You get to closing, and they bail on you. Then you're left at the altar, right? I deal with brokers. I always deal with brokers.
Same here.
Because the broker, what they'll do is they will find the lender for you, and they'll present you with options, and you can choose whichever option and give you the pros and cons of that deal or for that broker. But if something goes south, if something happens, they will find a replacement for you, even in a short term. Maybe they'll find a bridge. Maybe they'll find a hard money lender that can do the deal. They'll find something to get you into that deal, right? Yes. It's not free. It's usually costs a point.
They are solution driven, whereas if you're dealing with directly with the local community bank, they're not solution driven. They're looking for every reason, every risk to kill that deal. And that's what their focus is. When you go to a broker, you can be like, well, there's some issues with the financials of the property because of X, Y, and Z, and we can build a thesis how we're going to correct it. Then they can take that information and be able to get the deal done. What's interesting is it's easier to get a loan on a $1 million or $7 million property than it is to get a single family loan. There was a deal actually that we did together that I was short on my net worth. And I came to Agostino, and he came into the deal to help prop up my net worth so I can qualify for the deal. So there's a lot more solutions in commercial lending, but that broker is so critical. You can go to the broker with honesty and transparency. You know, I've got the skeleton in the closet of this issue, or my partner had a BK in the past, bankruptcy. You know, we have a credit card late because of this and that. You can disclose those things, and then we can build a solution around that to disclose that upfront to the lender. And that's another thing that's really critical. If you do have something that recently hit your credit or something undesirable, don't hide it. Bring it up front, be honest about it so you can work a solution around it in lieu of people finding out the 11th hour, because things happen. I had a credit card and some mortgage auto that were set up for auto pay, and the auto pay failed. Long story, but we were able to work through it, but we had to disclose that. It's been cleared up since then, but stuff happens.
But you want to get it out there as quickly as possible. Absolutely.
So basically, when we go through a property, for the first year and a half, when I buy a value add deal, it's a full renovation cycle. The income's low, the expenses are through the roof, and we have to have the ability to document and track the income, expenses, and capital expenditures during that renovation period. Once we're done with that and we have the property at a 90% occupancy or higher, that's when we're going to go into our 3 months of showing stabilized, our T3, our trailing 3, showing 3 months of what a stabilized income and expenses should look like, so that they take that T3 to a T12 and predict what the next 12 months is going to look like. So what we're doing is we're just really tracking our income and expenses. We're keeping tight records of it, and we're communicating with our broker that we're looking to refinance a deal. And we're probably going to start engaging in that conversation prior to the refinance, so we can start collecting documents and getting on the same page, getting everything kind of teed up, getting documents put together, so that once we have those 3 months of stabilized income and expenses, we can then start the refinance process. When we go to the broker, they're going to want to find out what our goals are. So when we get into a permanent lending product, we have a lot of options. We could be focused on, there's loan products that are interest only for a number of years. There are products where, but there's offsets and trade-offs for every loan product. There's products where they will have a prepayment penalty in the first number of years, but typically they'll have a lower interest rate. You may have a product that doesn't have a prepayment penalty, but the interest rates are higher. So you're going to have to take the time to understand what the options are and what your objectives are and what you're looking for. What we're going to look at is the lender's going to look at the net operating income. They're going to have an appraisal done on the property, and then you're going to have to determine at what LTV, loan to value, that you're looking to obtain on that property. So typically, if we have a property that's worth $1 million and the bank is comfortable on providing a 75% LTV, they'll give you 75% of the value of that building. So I don't know, $1 million, 75%, they'll give you a loan of $750,000. You can go as high as 80%, but typically 80% is roughly that's about the ceiling limit of what you're gonna be able to push it for. You can find life insurance companies that will provide amazing terms, but they may only be willing to go up to 65% LTV. So on $1 million deal, they will lend you up to $650,000. So each lender, whether it's a local municipality, whether it's Fannie Freddie, whether it's government agency, whether it's a life insurance company, those are going to be the 3 main players that are going to provide permanent financing. They're going to have different products, different rates, and different balloons. So one thing just to talk about briefly, when we looking at debt service, we're looking at how long we're going to amortize the mortgage over that period. So the more years we have in that, the lower the payment is, which is going to allow us to cash flow more. Typically, it's going to be 20 to 25 years typically. But then there's going to be a balloon event. The balloon event is going to be when that loan has to be paid off or preferably refinanced. And typically in commercial investing, commercial lending, typically that's between 5 to 10 years. So at year 5 to year 10, you're going to be forced to refinance that property or sell it or some other option at that point. So there's a lot of specifics here. The best thing to do is get hooked up with a really good commercial broker, commercial lender, understand the options, the advantages and disadvantages, and then making that decision at that point.
That's right. That's right. And just like I said, they're all different. There's actually a deal that we're working on that we're doing right now. It's with Sabal. They gave us a bridge on this 126 unit tower that we bought. The bridge is it's a 12-month. It's going to be up this coming March. We've done numerous improvements to this property. It's going to be a smoking deal when it's done. When we go to refi this thing, if we refi with someone other than Sabal, we're going to get charged I think it's a 3% exit fee or something like that, right?
Yes.
But we're not going to do that. We're just going to refi into some permanent financing. Maybe Fannie Freddie, maybe Sabal will do the deal. We're not sure yet. It depends on where the rates are, and the rates are really good at this point right now. So the point is that just to get pointed out, when we do the refi, it's already over 90%. We're getting the 3 month of the T3 basically, the trailing 3.
Stabilize.
And then we're gonna show it, and it's gonna be like they're gonna be super impressed with it, And over this time period, though, too, keep in mind, guys, that they're also asking for updates. They're asking us, hey, where are you with your financials? Show us a rent roll, show us a P&L. So make sure that when you are turning around one of these deals, that you are providing all this information to that lender, because they're going to want to see it if you're in a bridge situation, right? What we're in right now, So, your property manager, hopefully they have a good system that can provide this information. Again, working with an experienced property manager, like we covered in the previous show, that has familiarity with how to manage a project like this and the financials that go along with it is of paramount importance. You cannot go to some beginner that's never done this before and has some botched financials to a company like Sabal. Sabal, these guys are bulldogs. They are real players. They're based out of New York. That's just an example. You don't want to do that with any lender, but if you're going to play with the big boys, you can't screw that up. So what we've demonstrated so far is try to put together a real good, strong operational foundation around the properties that you're doing. So
that's another reason why a broker is so critical. When I go to like Chris Lesser, he has a track record of closing X number of loans with this permanent lender. He knows what they're looking for. He knows how aggressive they are. There's a certainty to close. If I go to a local community lender because I want to be cheap and I want to save money, I have no idea if that deal is going to close. I have no idea at the last minute what they're going to pull. Lenders all the time in the 11th hour, they change their criteria. They're like, oh, by the way, you have to bring an additional $300,000 to the deal tomorrow. Like,
that's right. That's right.
I can't stress enough that when you pay a fee to a lending broker, that fee, it's not a fee, it's an investment.
Yes.
Your ability to close that deal is the ability that you're going to be able to make money in that deal. If you lose a deal because you couldn't get financing, the earnest money's gone, your reputation, your credibility, your momentum. I mean, it's just the damage that it costs is just, it's just not worth it. Like,
that's right.
Pay the money to have a very credible broker that's going to be on your team, because this is a team sport. You could do single families by yourself. You're not doing this by yourself in the commercial space.
Absolutely not. Absolutely not. All right, guys. Well, thank you so much for joining us on this episode. If you have any questions, you want to ask us something about refinancing or anything else for that matter on post-acquisition strategy, you know what? You can ask us a question. You go to bulletproofcashflow.com. You're going to see a little button there. Ask a question. You hit that button. You can record your question. And if we use your question on the air on an upcoming episode, we will send you a free gift. It's going to be super rad. You're going to love it. Okay, guys. And of course, if you like what we're saying, you're enjoying the material, you're loving the knowledge that we're laying out for you, give us 5 stars, rate the show, leave a comment, tell your friends. Okay. Love to hear from you. All right. Do us that favor. Thank you so much for your time, guys. We'll see you on the next episode. All right. Take care.